Hey, YouTube family, and welcome to another video of the Kevin Strong Show. And in this video, we're going to talk about the ongoing banking crisis in the USA. So many people are talking about this. There's reports out there that out of the 4,300 banks in the United States, potentially 2,300 could potentially be insolvent. This is a big problem, so I'm going to give you some good content. Stick to the end of this video. I'm going to share some things with you that in history kind of indicate that we're probably going down a very, very, very dark path that we've traveled before. So if you're new to my channel, welcome. Please smash that like button, comment, and share because I care. So without further ado, let me go ahead and tee up this presentation. And once again, this is called The Banking Crisis. So let's go ahead and start off with this first point. There's a couple of key points actually that I'd like to share with you guys. So let's start off with key point number one. According to the FDIC data, the total assets of federally insured banks that have collapsed in 2023 is, in inflation-adjusted terms, more than the 25 banks that failed in 2008. So in layman terms, the 4 banks that have collapsed year to date in 2023, that dollar amount, when you adjust that dollar amount for inflation, is a greater number than the 25 banks that collapsed during the great financial crisis, i.e. in 2008. The New York Times reported that 3 banks held a total of $532 billion in assets. That's more than the $526 billion when adjusted for inflation. Once again, held by the 25 banks that collapsed in 2008 at the height of the global financial crisis. So think about this, guys. We still have 7 more months to go. Most of us do believe that there will be more regional and potentially a national bank that becomes insolvent. So at the end of the day, from a banking perspective, this is an ominous setup to be way more catastrophic from a banking standpoint than what we experienced in 2008. But yet and still, the national media wants you to believe that everything is okay. So I think we're in what's called the denial phase. There's just a lot of things that's right in your face, but you don't want to believe it because there's no solutions for some of these problems that we're dealing with from a banking standpoint. So let's talk about that. The Treasury and the FDIC are still in denial. This is in my humble opinion. They blame the failures on reckless lending, bad management, and over-reliance on footloose uninsured depositors by a handful of banks. So they want you, like with the Silicon Valley example, they want you to believe that this is not a systemic problem. There's not a national run on the banks, that our banking system is sound and solvent, and that these are just isolated incidents that the government clearly has under control. Despite that last statement, as I mentioned at the start of this video, we have a higher dollar amount with the 4 banks that have failed this year than what we had in 2008. But they want you to believe that this is an isolated incident and that everything's in control. The second bullet point in summary basically talks about federal public, basically how they deal with a lot of technology startups. We all know that was basically acquired by JP Morgan. And last, packages of commercial property loans, which are called CMBS, are typically on short maturities and have to be refinanced every 2 to 3 years. This is basically dealing with commercial loans. I've talked about this. So for those of you who are new to the channel, I'm going to give you a quick crash course. So a residential mortgage is typically, you can get a 30-year fix. Your payment never changes. With commercial lending, it's a little bit different. So you can have the payment amortized over a 25-year period, but typically it's going to be fixed anywhere from 2, 3 to 5 years, sometimes 7, but no more than 10. But most people have that within 5 years where the mortgage just has to be reset. So what happened, let's say in 2008, 2009, there's a lot of commercial loans that were taken out at really, really low interest rates. And now those loans are due and they have to be reset. You have to refinance. And the interest rates in 2023 are considerably higher than what they were 2 or 3 years ago. And because of that, a lot of commercial investors are not able to service that loan. It will force them to potentially go out of business. 70 to 80% of all commercial loans are originated by regional in small banks. So once again, when you see a massive withdrawal on deposits, and at the same time, these commercial loans that are going bad, it's a recipe for disaster for regional banks, because they're basically getting squeezed on both ends. One end is on the deposit side, and the other end is on these basically bad loans. They weren't bad loans in 2018, 2019, but because interest rates have gone up so much, you're going to see a lot of unrealized to realized losses with commercial lending. Okay, so here's some important facts that I like to share with you guys. Important Fed and U.S. economic implications as a result of what I think is going to happen as the banking crisis continues. Banks will inevitably be more cautious over lending, with the need to tighten lending standards and restrict credit supply in the economy. Companies and individuals will find it more difficult to get loans. There is also a risk that riskier loans to companies will get called, in which risk an increase in business failure. So basically, some of these business loans have certain things that if you don't meet certain matrix, so they basically do what's called an audit, and they don't think you can perform or service that payment, they can call the loan due on sales clause. So from a consumer standpoint, like back in 2008, when lending requirements really got tight, there were stories about people who had 750, 800 FICO scores, had 20 to 30% down, but they couldn't find somebody to approve them for a mortgage as lending just got tighter. And you're going to see banks get a little bit more apprehensive about lending in this environment, because interest rates are so high. And once again, at the same time, on the other side of that balance sheet, you've got your deposits being drained out of the system. So you're going to be very apprehensive to lend in an uncertain environment. So these are some of the things that the FDIC is coming up from a reform standpoint to once again quell or stop or prevent the systemic spread of a bank run in our financial system. The first option would be to maintain the status quo, but this would increase the risk of future failure. So that would not ensure any confidence in the system if they just kept things the way they are. Another option would be to remove the insurance ceiling altogether and insure all deposits. Now, in order to do something like that, to waive off the 250,000 cutoff, in terms of that's the part where from 0 to 250,000, if you have your money in a bank that's FDIC insured and that bank goes insolvent, the FDIC is going to come in and make you whole. If they waive that, basically to give the impression that no matter how much money you have in the bank, the FDIC is going to basically make you whole. They don't have the money. The FDIC is already broke. That would create hyper inflation, because we're already in an inflationary environment to begin with. And that's one of the main missions of the Fed, is to basically get inflation in check. So that might be a Band-Aid over a gunshot wound. It might temporarily solve something, but in the long run, we have a systemic problem, and that won't solve it. It also considers the most promising option that would be to introduce reforms with stronger protections for business accounts. Who knows how they can do that, but any type of intervention from the government will lead to higher inflation. As Morgan Freeman, I get Morgan Freeman out of my, I can't think of this guy's name, but the guy who's famous for saying there's no such thing as a free lunch. That guy. According to the FDIC, an insurance scheme that would give such business accounts greatly increased or even unlimited coverage could enhance financial stability by making it much less likely that those depositors would flee banks. So once again, they're trying to come up with these kind of creative ways to instill confidence in the short run, but in the long run, this system is broke. We are in a fiat debt-based system. Guys, just think about all the craziness that has happened as a result of people waking up and finally realizing, oh crap, I don't want to leave my money in the bank and only get 1%. I can get a T-bill for 5%, or I can roll over and keep buying T-bills every month or every 3 months. And it's upsetting the whole financial system, because people are waking up and expecting a decent return on their money. Can you imagine what the system would look like if we took that same mindset, that same energy and passion, and paid off credit card debt and didn't have a lot of credit card debt? The whole system would collapse. They need people to be complacent. They need people to be reactive, not proactive. Once again, just look how it's upsetting the whole banking system that people are actually trying to get a 4 or 5% return on their money. The system can't even handle that. And that return doesn't even keep up with inflation. So my final thoughts is that keep your accounts at $250,000 and below for the FDIC insurance. Spread your money around in multiple banks. I personally like credit unions. We're going to talk about that a little later on this slide. Buy T-bills. I'm a big fan of that. I've been doing that since the beginning of the year. This is not financial advice. This is just what I'm doing on a personal level. And if you are interested in buying T-bills, you can get them directly from treasurydirect.gov. I think we're going to be faced with long-term systemic inflation for like the next 7 to 10 years. I think what the Fed wants to do, once again, this is not financial advice. This is in my humble opinion. I think what the Fed wants to do is that they want the economy or the consumer to get used to systemic slow growth inflation because we have too much debt. So this big unicorn idea of the Fed getting inflation down to 2% will never be realized, in my opinion. I think they want us to get used to a higher systemic growth of inflation. And the balancing act is to do that without decoupling or imploding our financial system. And I think that's the balancing act in the long run that the Fed is shooting for, once again, in my humble opinion. So once again, about credit unions, right? In 2023, only 2 credit unions have failed. That's it. You don't hear anything in the news talking about credit unions going insolvent. You don't hear anything in the news or online about this big credit union can't meet their financial obligations. And as a result, the depositors are worried about their money, once again, is not 100% guaranteed. But if you're trying to mitigate your potential losses and you're worrying about insolvency, I personally believe that you're better off having your money in a credit union opposed to a bank. And then nationally, 2 have gone under already in 2023, credit unions, which I just spoke about. And on average, 7 failed in each of the prior 5 years, according to the data compiled by the National Credit Union Administration. So that's basically an entity that's equivalent to FDIC. And they're not as insolvent as the FDIC. So that was just some interesting information. I want to leave you guys with a couple of other facts from a historical standpoint that clearly leads to the point where history could be repeating itself. So in 2008, just before the great financial crisis, our gross domestic product went up 2%, and then the whole system crashed. Keep that in mind. So things were looking rosy, and then we crashed. In 1948, unemployment was 3.7%. And then we went into a recession, and then it went up to 8%. It doubled. In 1955, unemployment was a little bit under 3%. We went into recession, and then it doubled. It went up to 6%. So what am I saying here, folks? Historically speaking, when unemployment is really, really low, like the current administration is talking about now, that typically is a precursor or a litmus test to a recession. And because we're dealing with 40-year inflation in all-time consumer debt in a commercial bubble, along with the housing bubble and along with the corporate debt bubble, in my humble opinion, this is going to be a catastrophic, deep, wide, systemic recession, and we could tip over into a quasi-depression. So I hope you guys got a lot of good information from this video. Please click on that link below if you want that information about the credit unions. It talks about the history of the credit unions in terms of how many credit unions have failed each year, starting from 2012 all the way up to 2023. There's also information on that link that talks about how to determine what is a good credit union and where you should put your money with in respects to what kind of credit union that you're looking for. So really good information from the credit union side. So I'm going to end this video with my famous slogan. You know what I'm about to say. Keep your credit score up and your debt down. Please, please do me a favor. If you've stayed this long, just smash that like button so YouTube would share my content, comment and share because I care. This was the Kevin Strong Show, and I'll see you guys in the next video.